Let's start with something that needs to be said clearly, because there's a lot of noise around this topic. Real estate professional status sounds simple when people talk about it online. Spend some time on your rentals, check a box, and suddenly all your real estate losses become deductible. But in real life, that's not how this works at all. And honestly, this misunderstanding is exactly why real estate professional status has become one of the most audited positions for real estate investors. So today, let's slow this down and walk through what's really going on here, how investors usually get this wrong, and what the IRS is actually paying attention to. Now, before we go any further, let's clear up the biggest misconception. Real estate professional status is not an election. It's not a form. And it's definitely not something your CPA can just decide for you. It's based entirely on facts and circumstances. In other words, the IRS doesn't care what you call yourself. They care what you actually do with your time. All right, with that in mind, let's talk about what the IRS actually requires. There are two main tests. First, more than half of your personal working time during the year has to be spent in real property trades or businesses. Second, you must spend more than 750 hours materially participating in those activities. On paper, that sounds reasonable, but this is where things start to break down for most investors. So let's talk about why. Moving on to the first test, the time requirement. A lot of investors assume that owning rental properties automatically counts as working in real estate. It doesn't. Passive ownership doesn't qualify. Simply collecting rent doesn't qualify, and hiring a property manager doesn't magically transfer the work to you. The IRS is looking for active involvement. Things like evaluating deals, negotiating purchases, overseeing renovations, making management decisions, handling leasing issues, coordinating financing, and supervising operations. That's the kind of work that counts. Now here's where it gets tricky. If you also have a full-time job outside of real estate, the math gets uncomfortable fast. If you're working 40 or 50 hours a week somewhere else, you have to prove that you spent even more time than that on real estate activities. Not around the same, not close enough, more than half. And this is where many reps' claims quietly fail without people realizing it. All right, now let's move into something that trips people up even more: documentation. Because even if you do spend the time, you still have to prove it. The IRS does not accept estimates. They don't accept recreated logs years later. And they definitely don't accept general explanations like, "This is what I usually do in a week." They want contemporaneous records. That means logs are created as the work is happening. Dates, hours, activities, and which properties those activities relate to. It doesn't have to be perfect, but it does have to be consistent and believable. Here's the problem. Most investors don't do this. They qualify on paper, take large losses, and assume everything is fine. And then years later, when the IRS asks for proof, there's nothing solid to back it up. That's when the entire position falls apart. Now, moving forward, let's talk about material participation, because this is another layer people tend to gloss over. Even if you qualify as a real estate professional, each rental activity still has to meet material participation rules, unless you properly aggregate your rentals. Aggregation is optional, but it's incredibly important. Without aggregation, the IRS looks at each property separately. That means you'd have to materially participate in every single rental. For most portfolios, that's just not realistic. So many investors choose to aggregate. But here's where things get interesting. Aggregation isn't just a checkbox either. Once you aggregate, it affects how your rentals are treated going forward. It impacts future years, dispositions, and how gains and losses are recognized. In other words, aggregation is a long-term decision, not a casual one. Now let's shift gears and talk about why the IRS focuses so heavily on real estate professional status. The reason is simple. REPS unlocks big deductions. When REPS is valid, losses from rentals can offset ordinary income. That includes wages, business income, and other high-tax income sources. Pair that with cost segregation or bonus depreciation, and the tax savings can be substantial. And anytime there's a strategy that powerful, it attracts attention. The IRS knows this area is abused. They know hours get stretched. They know logs get created after the fact. They know spouses are sometimes listed as participants without real involvement. That's why reps audits are detailed and aggressive. And here's something a lot of investors don't realize until it's too late. If the IRS disallows your real estate professional status, they don't just reverse 1 year. They can go back multiple years, disallow losses, and assess back taxes, penalties, and interest all at once. That's where this becomes expensive. Now let's pause for a second and talk about something that surprises a lot of people. Real estate professional status is not always the best move, even if you qualify. This catches people off guard. If your income is already low, or if your losses would be suspended and released later anyway, claiming reps may not improve your long-term outcome. Sometimes timing matters more than qualification. And this is especially true when reps is combined with cost segregation. Accelerating depreciation into a year where you don't need it can limit flexibility later. And if exit planning isn't considered, depreciation recapture can undo a lot of the benefit. Which brings us to exit planning. Moving on, let's talk about how reps fits into the bigger picture. Reps should never be evaluated in isolation. It has to be coordinated with how long you plan to hold the property, whether you expect to sell, refinance, or exchange, and what your income picture looks like over time. Without that coordination, reps becomes a short-term tactic instead of a long-term strategy. Now let's talk briefly about spouses, because this is another area of confusion. Only one spouse needs to qualify as a real estate professional, but the hours still have to be real. You can't assign hours to a spouse who isn't actually doing the work. Courts have consistently rejected cases where involvement was minimal or poorly documented. So again, this comes back to reality and records. All right, let's start wrapping this together. Real estate professional status is powerful, but it's fragile. It works best when it's planned, documented, and coordinated with the rest of your tax strategy. It's not about gaming the system. It's about structuring your involvement correctly and being able to support it if questioned. So here's the real takeaway. Reps isn't something you casually claim. It's something you build into your overall strategy. And investors who treat it that way are the ones who actually benefit long-term. If you're considering real estate professional status or already claiming it and want to make sure your position is solid, defensible, and aligned with your bigger tax picture, head over to gavtax.com. Because with reps, the goal isn't just to save taxes this year, it's to make sure those savings hold up. See you in the next video.